Hey everybody, Jon Grauman from the agency here with yet another market update for you. So, where are we? Well, we're exactly where we thought we'd be. It's the dead of summer, the markets cool off a little bit, but nothing to be worried about. We literally see this happen every single year. As the temperatures heat up, the market cools down. It's just summer seasonality. Here's what's really exciting though. The first rate cut seems to be all but guaranteed to happen next month in September. The capital markets have essentially already started to build this in. In fact, speaking of the capital markets, they obviously experienced a little bit of turbulence themselves a couple weeks ago, but the silver lining in that is that it brought down the 10-year yield, which is directly tied to where long-term mortgage rates are. We've seen mortgage rates now being quoted sometimes in the low sixes, depending on who you are and who you're borrowing from, maybe somewhere even in the high fives. And all of this just continues to apply pressure on the Fed to reduce interest rates. I've said this before, the housing market is not going to be dictated by what the capital markets are doing. Not to say it doesn't play a factor, but the housing market's going to be dictated by interest rates and supply and demand. I'll talk more about that in just a moment. Now, the first rate cut is going to be largely symbolic in nature, meaning it's probably not going to affect your pocketbook in a meaningful way, but hopefully it signals that the worst is behind us and we're on the ascent. And again, there is so much pent-up demand sitting on the sidelines, so many people that are eagerly watching and waiting for this first rate cut, and once we get a couple of rate cuts behind us, I think you're going to see those people come off the sidelines, re-engage in the market. That's going to create more competition, and competition does what? It drives prices up. Now, all of this information could not come a moment too soon because we've actually seen a measurable uptick in inventory levels. Specifically here in LA, since January, inventory is up over 30%, which means we're seeing an inverse of the imbalance we're used to seeing, where usually there's too much supply and not enough demand to meet it. Right now, there's actually an oversupply and not enough demand to meet it, which is being exacerbated by the sort of lull we're seeing in these slower summer months. So if we were to stay on this trajectory, it would likely start to apply downward pressure on home prices. The only thing that might intercede that would be the first rate cut. So again, this information couldn't come a moment too soon. If it does happen next month, it interestingly happens essentially at the doorstep of the election, which is going to play its own factor. So frankly, I'm not sure what the next 60 to 90 days look like. Could be a little bit dicey, but I'm very bullish on what the next 6 to 9 months look like. So stay tuned for more information and I'll continue to keep you updated.